Welcome, first of all, to everyone who came tonight, and thank you so much. I'm Jeff Kirby with Discovery Anesthesia, joined by my partners, Matrina Whitley and Parker. And for those of you who don't know us already, Discovery Anesthesia, we are a small CRNA-owned CE company built by CRNAs for CRNAs. We provide continuing education credits online so that you can do them anywhere, anytime. You can take us with you on your vacations and get your CE credits however many you need. We have several different options, several different formats, so we try to keep it interesting for you. With that said, I'm going to turn you over to Jennifer Parker. Go
All
ahead.
right. Okay, so I'm going to introduce our speaker tonight. We're joined by Ben Barnhart. He's a certified financial planner and an IRS enrolled agent. He's the founder of On Point CRNA, Barnhart Wealth Management. Ben is CRNA focused. He's a CRNA focused financial planner who works with anesthesia professionals across the country. And he's also married to a CRNA, so he genuinely understands the 1099 world that we're living in. Tonight, Ben is going to break down 1099 taxes for CRNAs, including common mistakes, deductions people miss, quarterly taxes, and the basic of choosing business structure like sole proprietor versus LL versus S corp. And he's going to do this in plain English for us. So, Ben, welcome. Thank you for joining us tonight. Take it away.
All right. Thanks, Jen. Excited to be here. I've got a lot of great content to go through. So I'm going to share my screen here and we'll jump right into it. All right, you guys should be able to see the slides now. Okay, so get this out of the way on the front end here. So in today's litigious, crazy world, I'm going to trust that everybody is reading all the words on the screen here. None of this is intended as financial advice. So when I say things like you should do XYZ, mentally just translate that to this is worth asking, your financial professional. So with that said, as far as an agenda here and what we're going to get through today, we've got about an hour planned out. So I've got, again, the theme 1099 specific. We work with clients, I think, in 30 some different states now, all across the country. Probably 95% of our clientele is CRNAs, and this is not in any way intended to be a sales pitch. So I come from, a family of teachers and educators and everything, and I really enjoy doing these presentations. My vested interest, if you find the information valuable, there'll be some things at the end if you want to reach out, but really supposed to just be educational, focused.
I'm sorry, can I interrupt you just
Yeah,
for
go
one?
ahead.
Because I want to make sure that everybody knows, because I'm sure there's going to be lots of questions at the end. And if we can't get to everybody tonight, what we're planning on is another question and answer session. It's going to be, I believe it's next Monday, January 27th at the same time, 7:00. So if Ben doesn't get to everything you guys want to talk about, you can, we'll be sending the information out if you've already gotten emails from us, and you'll get a link through that. Sorry, Ben, I just want to make sure
Yeah, no,
you're
I'm
available.
glad you brought that up. So even like with webinars like this in the past, I might cover something, kicks off an idea, throw it in the chat. We'll get to it at the end. I'm going to go through this relatively quickly, kind of jamming, 10 pounds of what in a 5-pound bag in a 1 hour meeting here. There's going to be a replay. We'll do another office hours Q&A next week. So really this
Just Tuesday, not Monday, Tuesday next week.
Tuesday, yeah.
Yep.
So yeah, just five quick things to button up tax picture for last year. Be ready for this year. What stuff has changed tax law wise with the OBBA tax bill last year into 2026. Got a couple of quick case studies, and then I've got some free resources that hopefully we'll be able to send out to as far as like Excel spreadsheets, stuff like that. So I'm going to jump into it here. So step number 1, locking in the tax pictures. Really going to teach this as almost like a five-step reset. Intentionally, these are going to be pretty boring, but if your current tax plan with 1099 income relies on future you being disciplined, hopefully the goal is we can kind of upgrade that, tonight. With the first step, locking in the tax picture, what we want to focus on with 1099 income, obviously, hospital's not taking any taxes out of your paycheck anymore. So one of the big gotchas that I see all the time is what is my tax bill going to be? How much should I be setting aside? Do I make estimated payments? Do I make the S corp election? There's all these decisions. So what we typically do is we use what the IRS calls safe harbor. What that essentially means is you take last year's tax bill, and it's a kind of a convoluted formula, but it spits out how much you need to pay into the system throughout the year. Uncle Sam wants his money in the quarter that the income is earned. So it's intentionally a pay-as-you-go system. The way that that functions, I'm going to use big numbers to make math easy. Let's say 2025, you owed $100,000 in federal taxes. For 2026, to make sure you hit safe harbor, you need to at least pay in 110% of that number. So it'd be 110 grand. Now, again, pay as you go. So Uncle Sam wants that 1/4 of it at each date. The way the dates work are kind of funky too. You'd think they'd be 3 months apart, but leave it to the government. Anything they do, it doesn't necessarily make a ton of sense. But basically, those quarterly dates are April 15th. So you still got plenty of time to make your first quarter's payment for 2026. June 15th, September 15th, and then January 15th to still count it for last year. So that's one option, is to make your quarterly payments. The other option would be is if you are maybe moonlighting, you've got a W-2 gig through the hospital, or maybe you have an S corp where now you're paying a W-2 salary out of your S corp, which we'll get to here in a minute. You can, and this is, I see this missed a lot with W-2 tax withholding. Uncle Sam views that as automatically being paid equally throughout the year. So what you can do is just go over withhold on the W-2 to get you to safe harbor. The reason I like safe harbor, it's penalty free. You could, in that example before, as long as you paid in that 110 grand, you could have hit the lottery and made $1 billion. It's still going to be penalty free because at least you hit safe harbor. So that's what we always try to do. It's an easy way to crunch the math on it. And then, what we like to do is kind of peel off the dollars and set them aside into a high yield savings account for as long as possible, and then automate that tax payment. So logging in, scheduling it out. You don't have to think about it throughout the year. And then what we typically do too, just as kind of like a pro tip, because I've seen, again, the IRS in their infinite wisdom, they lose estimated payment checks. No, we never got that payment. And if every payment, let's say, is $30,000, and they say, hey, we're missing a $30,000 payment, you don't know which one they were missing. So what we usually recommend is for each quarter, make it a $30,000 in $1, $30,000 in $2, $30,000 in $3 to correspond to the quarter. That way, if they do lose anything, okay, it's the $30,000 and $3. I know that they lost my Q3 payment, and here's the records for it. So, little pro tip, as far as that's concerned. Next big thing that I see missed a lot is focusing on maxing the right retirement bucket. Hindsight's kind of 2020 with the estimated payment stuff, right? We're already past that January 15th deadline for last year. We can just get it dialed in going forward for 2026. With the retirement plan funding stuff, we still have retroactively up until your tax deadline, which if you're an S corp, it's March 15th. If you're just a LLC tax as a sole proprietor, it's April 15th. So we still got a couple months here. You can retroactively set up a solo 401k or XYZ retirement plan we'll talk about here in a second, and still make contributions to retroactively apply it to last year, driving down your taxable income. So I am going to talk a little bit about, the big idea here being maxing. It's not just about maxing a retirement account, it's maxing the right account. So just a couple quick bullet points here. What we typically recommend for CRNAs is a solo 401k. There's a lot of other, colloquial names and everything, Keogh plan and solo K, things along those lines. The reason I like the solo 401k, and with any of the stuff we're going to talk about tonight, my wife's 1099 CRNA, I'm obviously self-employed. Eating what I'm cooking with this, right? So this is what literally we have set up for ourselves, not only just our clients. I like the solo 401k for a couple reasons. Compared to the next best choice would be a SEP IRA, get a lot more flexibility. You can contribute after tax. You can do a backdoor Roth contributions, just kind of opens up Pandora's box with other things that we can do. As far as limitations for 2025, an employee could put away $23,500. This year they bumped it up $1,000. So whether you're a 403B through the hospital, that employee portion doesn't change. Now the neat part is if you have already maxed out your 403B or your 401k through the hospital, you can still give yourself what's called a profit sharing in your solo 401k. That could go all the way up to the $72,000 limit between your employer match or your employer profit sharing portion. That can all add up to 72 grand. So where a lot of the folks on this call are income wise, that's $30,000 in tax savings, right? Being able to go max max fund that type of retirement plan. So with some other nuances that I like with the solo 401k, we could talk for a whole hour about like the complexities of a backdoor Roth strategy. Here's the idea. A Roth IRA compared to a pre-tax retirement account, you're paying the taxes on the front end. Follow all the rules, all the growth in the long run is tax-free. Uncle Sam is wise to this. They know, he knows that these accounts are a good gig. So high income earners, everybody on this call is going to be over the income limitation. And because it is such a good gig, they limit how much you can put in there every year. So there's a way to sidestep that. There's a loophole in the tax code. It's called a backdoor Roth. The catch is you can't do the backdoor Roth because it triggers what is called this pro rata rule if you have pre-tax money outside of an employer-sponsored retirement plan. Well, if you have a solo 401k, what we would then do, let's say you have an old rollover IRA, is do what's called a reverse rollover, move the money back into the pre-tax portion of the solo 401k, magically preserves your eligibility to do this backdoor Roth now going forward. That's I see that one messed all the time, just because there's a bunch of tax reporting things and there's some complexity to it. But I've got some other slides that kind of quantifies the value of doing that here in a couple slides. As far as timing, I mentioned that we have until the tax deadline. Now there's one nuance with your S corp. You have until the tax deadline to fund the account. But if you have an S corp, you got to cut yourself a W-2. Now that W-2 needs to be reported by the end of the year. So if you didn't report it on your W-2, you potentially missed the boat on it. You might be able to work with, Gusto or ADP or whoever's doing your payroll and try to get them to do a W-2 correction. If not, you can still do that 25% profit sharing. Again, I'm not going to read everything off the slide here, but kind of just breaks down simple IRA, or the SEP IRA is simple. You can only do the 25% of your compensation. So let's say you're a S corp owner and you pay yourself $100,000 salary to make math easy. You can only put away 25 grand pre-tax in there with the SEP, and you can't do the backdoor Roth because it's an IRA, not an employer-sponsored retirement plan like a solo 401k. With the solo 401k, if you're an S corp, you could do the 24/5 as the deferral plus the 25% profit sharing. So you can put away more pre-tax, get more flexibility, opens up the backdoor Roth. Usually, hands down, the solo 401k is the way to go. Again, without getting way too far in the weeds here, do a full 2-hour presentation just on this. The type of solo 401k that we recommend is one that has a little bit more meat on the bones in terms of provisions available. So Vanguard, Fidelity, LPL, Edward Jones, all these major custodians, they all offer a quote unquote free solo 401k plan. 5 minutes, you could have a solo 401k set up on schwab.com. Those are great, and it does everything that we just talked about. The plans that we like to draft are ones that actually require essentially a retirement trust document that's like 30 or 40 pages long, has to be notarized, and it opens up some of these other provisions. So we talked about the pre-tax contributions. We talked about Roth contributions. It allows for a third type of contribution, an after-tax contributions. It's really the gateway to that mega backdoor Roth strategy, which allows you to get up to that $72,000 limit, sidestep even more income limitations, get more money funneled into an account. Hopefully you never have to pay taxes on it again. On top of that, most plans, when you draft them with a third-party administrator, they'll also allow you to qualify for being able to take a loan from your 401k, being able to invest in other things, physical collectible assets like actually owning physical gold or real estate or Bitcoin outside of that. Not necessarily that we recommend a ton of that, but it's just more flexibility. On top of one step further, there's a provision available still. The Department of Labor knows that not a lot of people are funding their retirements. There's going to be this deficit, right? People living paycheck to paycheck. So they want to incentivize employers to establish these plans for their employees. Well, everybody on this call that's self-employed, you are your only employee. So of course, you're going to opt into and check the box for the auto enrollment tax credit. That tax credit gets you $500 for the first 3 years. It's a credit, not a deduction. So literally just setting up this plan, you get $1,500 back in taxes for opting into that credit. And it opens up all these other benefits. So quick example, when I talk to clients a lot, it's easy to quantify. All right, if I push 50 grand into a retirement account pre-tax, it's going to save me X in taxes today. Everybody can wrap their head around that math. It's a little bit tougher to quantify and say, okay, if I do X amount of dollars in this mega backdoor Roth or regular backdoor Roth strategy, I'm not saving any money in taxes today. How much am I really saving in the long run? So just quick example, and you can thank my wife for some of the anesthesia pun names here for helping me come up with this. But basically, I've got 2 CRNAs, each moonlighting with some 1099 work. Here's the key. Nora over here is going to save 33 grand and some change to an investment brokerage account. And Anne saves the same 33 grand, but she makes this magical after-tax contribution to her solo 401k. It's the same investment rate of return. I'm just using a long-term 8% for the next 30 years. Her 33 grand in both scenarios, they grow to the same amount. We're just changing where we're investing the dollars. Nora calls up her advisor, says, hey, I'm going to go buy this beach house. I need $1,000. Send me a check. Advisor says, okay, but we got to pay long-term capital gains on what's inside of there, costing Nora about $72,000 in taxes at that point. Versus Ann says, hey, send me the check. She nuts the whole check. So pretty easy way to see kind of the value of sheltering, not only from taxes today, but in the long. Again, this is kind of just illustration without spending a ton of time on it, but just to show kind of like how these are calculated. Main key here, LLC taxed as a sole proprietor. CRNA makes 200 grand in self-employment income. Maybe they actually made like 210. They take some write-offs for mileage and home office and stuff. 200 grand's the net income. So we throw together a contribution. I'm using 2025 numbers because that's what's really relevant right now, still counting it for last year. She could do that 23.5 as a pre-tax contribution. She would do 37,280 profit sharing. And there's some nuance here. I'll spare everybody on the details on how this is calculated. But we could also do 9 grand into this after-tax contribution. I'd much rather you funnel it into there than just saving in a high-yield savings account or a brokerage account. One more scenario here, and I think I just showed as the same math. Everything else is equal. I just break it out a little bit further with an S corp. So CRNA makes 250K, W2 with 150 grand as an example. Their K1, which is the distribution from your S corp, is another 100. Now the difference is the way this is calculated with a SOL is you still do the 23.5, but now you only get to contribute based on just the W2, and then she can still do the extra 9,000. Getting up to that $70,000 limit. Okay, so one more comparison here, kind of like quantifying the value of that mega backdoor. These are young clients. Let's say they do it for the next 20 years of their career. So they're doing 9 grand a year for the next 20 years. Spare you on all the details here, but basically S&P 500 over the last 100 years has done a little over 10.5%. We got some tax calculations. I use long-term inflation. Basically what I'm trying to do is just apples to apples. All right, so you save 9 grand a year for the next 20 years, just in investment growth, got $254,000 in there, above and beyond what you've contributed. Versus the Roth IRA, again, you don't have the tax drag from dividends and interest, and you don't have that capital gain tax at the very end, grows to that 386. Basically, they get to keep that full just gross number because there's no taxes weighing on the performance of it. Bottom lining it, it's almost like they made another 2.3% a year on their investments. They're invested the exact same way. At the income level that everybody is at on this call, playing the tax game, however the old saying goes, it's not what you make, it's what you keep, right? So doing creative things like this, because even in retirement, many of you, to live the lifestyle you're going to want to live, are going to be pulling a lot of money out of retirement accounts. So ensuring not everything's just in pre-tax or everything's just in real estate or just in after-tax, being diversified in where you own what is important too. And then just one more kind of quick idea. We've set up a few of these in recent years. Cash balance plan functions like a pension whereby you contribute to it. There's a defined benefit at the end at your goal retirement age. It's kind of expensive to set up. The third-party company we use charges a couple grand to just establish these plans, few $1,000s a year to administer them. Basically, there's a team of actuaries that design these plans. And the advantage is you can defer a ton more money into these plans. This year, I had a client that we set up a solo 401k for. He had a SEP IRA, ironically. We set up a solo 401k. He made, I want to say, just working a ton of hours. I want to say he made like 280 through W2. He made like another 250 in 1099 income. Bouncing around different states, just, 60 years old, just trying to hammer a bunch of money away, get to retirement. So he had made any estimated payments throughout the year. By setting up these combination of plans, he went from owing about 140 grand in taxes to getting back about 15. Huge swing. Right now, here's the catch with these plans. He had to pump a ton of money into these retirement accounts to get the deduction. You have to have reasonable expectation. You have consistency with the income. have to have a decent runway that, you're not just going to do it for 1 year and then terminate the plan. The way these function is different than a pension. You fund the plan at the end of the plan, the target date of retirement. Instead of taking it as an income stream like you would think of a pension, we just terminate the plan and roll it over to an IRA. So it functions as a great savings vehicle in between there, and then set up to be a pension, but then we treat it just as a normal retirement account. The last thing. Okay, yep, that was it on cash balance. So step number 3, dialing in the entity and payroll. So if you are an S corp, if you're not an S corp, talk a little bit about some payroll stuff that I see missed all the time. The sole prop LLC, and for those on the call, I know we had some comments of like CRNAs exploring taxes. So I do hear this all the time. You have an LLC. An S corp is an election underneath an LLC. If you don't make the election, which is just a 1-page form to the IRS saying, hey, I'm going to raise my hand and I'm going to elect to be taxed as an S corp this year, it defaults to the sole proprietor. If it defaults to the sole proprietor, it's taxed the exact same way whether you have an LLC or not. Okay, the LLC is just a liability wrapper that goes over it. All right, so you're an LLC, you make the S corp election. This is a big question, and it really, I'm hesitant to give any like concrete answers on this, but the whole idea with the S corp is, let's say you make $300,000 as a CRNA, 1099 income, you're going to owe payroll taxes on the first 180 grand and some change. I think it's 184.5 this year. Those payroll taxes are huge, 15.3% when you're self-employed. So the idea with the S corp is, what if we paid you $120,000 salary? Well, that difference of $50,000, you're not paying the self-employment taxes on. So to do some ballpark math on that, if it was 50 grand, just to make math easy, we're talking $7,600 just for making the S corp election. Now, there's a trade-off there. What you save in the FICA taxes, you can't put as much into the retirement plan. And the IRS, I think, is intentionally vague on what they call a reasonable salary. There's a fine line to walk there. I like to think of it as almost like a cost segregation, where not everything you're doing is $200 plus an hour work, right? Credentialing, commuting, those are all, somebody to fill out do your CE stuff. That's not $200 an hour work, right? So justifying it to the IRS is, as a business owner, yeah, you might get paid for your time in the OR, but that's not everything you're doing as a business owner now. So that's one part of it. There's different schools of thought on the right salary. A lot of it's regionalized. We really kind of try to customize that for each client, because that's really going to be one of the biggest audit risks you have. I'd love to pay you $1, right? No FICA taxes. Problem is it would probably be I don't know of any CRNA that would work for $1 a year, right? So that'd be hard to defend. So that's a big thing on the S corp. Now, the other thing I notice all the time is with the S corp, you're self-employed, so you're maxing out your HSA, you're paying for your self-employed health insurance. Let's say between the two of them, it's $20,000 a year, to make math easy, and you're paying yourself that $120,000 salary. I want you to take it as a business deduction and then include it on your W-2 as income. So we're literally we're moving money from the left pocket to the right pocket, robbing Peter to pay Paul, however you want to put it. Why would we want to do that? Well, it gets us to that 120 reasonable salary. But the cool part is that $20,000 of benefits isn't subject to payroll taxes, isn't subject to self-employment taxes. So we get to call your reasonable salary 120, but now you're only paying payroll taxes on 100. So again, that saved 15.3% on 20 grand, $2,000-$3,000 tax savings right there. So like a lot of these strategies, really, it's a couple grand here, a couple grand there, some tax credits, they really start to add up to real dollars, by the end. I see that one missed all the time with new clients that come to us. One, there's hoops that CPAs, if they know exist, it's additional to jump through. They don't make any more if they save you $2,000. We focus on that, with our clients. The other thing I see missed a lot, but when you have an S corp, is having an accountable plan for your reimbursements. So when you are an S corp owner and you're paying yourself as a W-2 employee, you are automatically greater than a 2% shareholder in your company. You're the only shareholder in your company. Because of that, you can't take a home office deduction directly on your S corp tax return. It's a mixed business use expense. The only things you can write off on your business return are 100% business use expenses. CE costs, like with Discovery, anesthesia, travel expenses, things that are 100% business related. So what do we do with your mileage for your vehicle? or your home office, or a trip that you took to go to the Bahamas to do a CE class, but you ended up staying for an extra week. You still get to write off the flight, but only a portion of the lodging, right? So that all has to be done through what the IRS calls an accountable plan. And it has to be done in a substantially, their verbiage I want to say is a substantially reasonable amount of time. Which the IRS, there's some case laws and tax studies and stuff on this. It typically means 3 months. So what that means is that once a quarter, you log in, you fill out an Excel spreadsheet that calculates all these misuse expenses. You move it from your business account to your personal account. Let's say it's $4,000 for that quarter, and you write it off as a reimbursed employee business expense. You just got to move $4,000 out of your business tax free. Now, if the IRS comes back to you, they're going to want to see the receipts of, how you came up with that number, which is why you're doing it on a timely basis once a quarter, and you're filling out the Excel sheet. You get audited. Here you go. Here's the money moving from the accounts. It doesn't need to be reported on the W-2, keeps it clean. And then it essentially is just reported that way on your 11, which is your S Corp tax return. And then this is not going to be as popular this year. Acronym, the IRS loves acronyms. So the Pass-Through Entity Tax, PTET. Big debate. One big, beautiful bill act passed earlier this year. Took forever to get through Congress. Major sticking point was the SALT cap. Another acronym, state and local tax deduction cap. Previously was capped at 10 grand. Most people on this call, between your property taxes, your license plate fees, and your state income, depending on which state you're in, well over 10 grand, right? So the thing to do would be to make this pass-through entity election and write off your state taxes through your business. Okay, so this year probably doesn't make as much sense because you're going to get 40 grand now. So unless your property taxes and state taxes are going to exceed 40 grand, it's a lot of hoops to jump through with each state. Could be a mess if you're in multiple states. Juice probably isn't worth the squeeze on it. It'd be a moot point. In fact, could even be a bad thing if your CPA is doing that and you're not at the 40 grand, because what it does is it reduces your K1 income and it phases you out of the QBI deduction. So without getting too tax nerd speaky, the QBI deduction, you get to write off automatically 20% of your business income separate from your U2. Well, if we're driving down your business income, it's eating into that 20% write-off. So it ends up being, I would call it like a QBI deduction reduction. You end up shooting yourself in the foot a little bit. So that's something we want to look at, but really it would only be high income tax state. You got $30,000 in property taxes because you live in a mansion or in, a high income area, then it might make sense. All right. So number 4, kind of moving along here, controlling the stuff we can't control, right? So none of us have control over tax code or what the stock market's going to do. So just benefit stuff for 2026, self-employed, just covering yourself. It's $4,400 on the HSA. You can do it up to 87. 50 for the family plus 1,000 additional if you're over age 55. Again, I would run that through your payroll if you're an S Corp. We already talked a little bit about that. Making sure those premiums, open enrollment checks are all dialed in. And then the one thing I want to touch on with disability and malpractice. So malpractice, 100% right off through the business. That's usually a good, for a lot of you bounce around different states, negotiating low income contracts, that can be pretty expensive, so maybe that's a negotiation point. Hey, cover my malpractice for me. It is a good thing to always, what are they going to do? Say no? Then you got to buy it anyway. So we usually recommend that's a decent thing to push back a little bit on. And then disability insurance, you can write off disability insurance. The problem is if you write that off, if you ever collect on it, then the income is taxable. So we don't typically want to see that small write-off relative to potentially if you collect for 30 years, that could, you probably need a bigger policy then if you're going to have to pay taxes on it. So I've got a slide on insurance here in a minute. I won't get on my soapbox about disability insurance quite yet. Slide number 5, step number 5, just some common write-offs. Okay. So stuff that usually gets missed. This is going to be super important. I've got a freebie we're going to send out to everybody of what we use with our clients of an Excel spreadsheet that details everything CRNA specific as a downloadable kind of freebie for attending. So I'm not going to read everything off here, but again, S Corp got to have that accountable plan, home office deduction, whether you want to take the automatic per square footage or you want to use, the more nuanced of where they, you're going line by line and adding up all your water bill throughout the year and everything. Sometimes that can yield better results. nicer area. You take some depreciation on the house. There's some moving parts there, but it could make sense. The spreadsheet that I'm going to send out calculates all that. So you like side by side it and it optimizes for the bigger number. Same thing with mileage, or in this common question, right? Do I take the mileage? Do I buy a car? Do I lease a car? What's the most beneficial for me? A lot of times, if you're just an LLC taxed as a sole proprietor, we got until the end of the year to figure that out. The catch is with that S corp kind of up against the shot clock on how you're going to be reimbursing yourself throughout the year with that accountable plan every quarter. We see CE, CME stuff, licensing, professional dues, equipment, bonus depreciation is back. So, you never want to go buy stuff just for the write-off. I love seeing that on social media. It's kind of the, that's why I buy a G-Wagon every year so I can write off this $300,000 car. Yeah, but it's also worth half as much 2 years from now. And the phantom tax that nobody talks about on the social media videos is when you sell that car or go trade it in for a new one, you have to do what's called depreciation recapture. You write off your $300,000 G-Wagon, you sell it for 150 3 years later, you have to put 150 grand of income back on your tax return now. Now, hopefully, the idea would be you just buy another G-Wagon, but again, it's depreciating, right? So, and that depreciation isn't going to exceed, the tax value is not going to exceed the depreciation amount. So it's great if you need a car and you got to go buy a car, but you never want to buy stuff just for a tax write-off. That's a big misnomer. Bookkeeping, tax prep stuff. So we always recommend separating business account, business credit card, have your 1099 income deposited right to that business account. My wife gets paid every 2 weeks from her 1099 job. We've got an American Express business account. There's no fees on it. It was easy to set up. I don't obviously work for Amex. She gets paid. I immediately move it to our personal. There's no reason to keep any money in there until we got to run the S corp. Once a quarter, I run the payroll. I just move back into there what needs to be debited for the payroll, and I'm investing the dollars other places, right? I don't want to be too cash heavy. We use a separate account not only for liability protection, but also it makes your life way easier at tax time. Anything that's 100% business expense, put it on the credit card. All you got to do in this time of the year is just go pull all your credit card statements. There's all your expenses. You've been doing the accountable plan. There's all your other expenses. I did all of her stuff at the end of it took me 10 minutes because you're biting it off in chunks, right? Yeah, 10 minutes once a quarter is all this should really take. So thought about categorizing this. I hits on the same stuff. Charitable contribution stuff. So less specific to CRNAs, but this is kind of a gotcha. I think we're going to deal with more and more of this here. If you itemize now, before it was every dollar you donated to your church or to charity, you got 100%, whatever that was as a percentage of the income as a write-off. This year, they're instituting a floor. What that means is it may be, let's say, I've got a client that gives $5,000 a month to their church, $60,000 a year to their church. They're all about donating, a percentage of their income to their church. What that means is for that $60,000 in donations this year, it's limited to 0.5% of their AGI, or it doesn't kick in until 0.5% of their AGI. So let's say they made $1 million. 0.5% of that is $5,000. So they're of that $60,000 in write-offs, they're only going to be able to write off 55,000 of them. So one thing to it's the same thing as buying something, right? You don't donate things to get the tax write-off. That's just kind of a cherry on top. But if you are charitably inclined, maybe it makes sense to bunch your deductions. Maybe it makes sense. This is a DIF, another acronym, a donor advised fund. So we did that with a few clients last year because we knew it was going to kick in this year. He basically, this client I was talking about, put 150 grand into a donor advised fund. He didn't send it all to the church in 1 year, and now he's going to invest it and parse it out over the next couple of years, but he gets the whole 150 grand for this year as a write-off. Big income years, small income years, there's some planning stuff you can do around that. Last couple things, we talked about salt cap, itemizing, coming back as far as optimizing that. We talked about charitable stuff. There's some additional catch-up provisions this year. You basically get an extra catch-up, and this year, any of those extra catch-ups have to be done on a after-tax or a Roth basis. 2 quick case studies. I've got CRNA that part-time 1099 work, full-time jobs W-2. Underpaid your estimates throughout the year, potential penalties. What we would recommend is bumping up your W-2 withholdings. I'm all about simplicity. Why give yourself the headache of writing an estimated payment for $2,000, depending on how much work you're doing every quarter? Just over withhold on your W-2 through the hospital. So it's all going in the same place, tax return wise. And then if they already maxed out their 403B through the hospital, we could still set up the solo 401k to do the profit sharing pre-tax component. and the after tax for the mega backdoor Roth with their 1099 income. Full-time S Corp, CRNA, we want to calibrate the reasonable salary, mixed use reimbursements for the accountable plan. We talked about the PTET, and then kind of optimizing, does it make sense to take accelerated depreciation for like a vehicle purchase, cash balance plan, stuff like that. And then I've been talking here for a minute, so grab a drink of water, but that is most of the educational, just like 411 stuff I wanted to get through today. What I'm going to do now is just show a couple tools and resources of how we work with CRNAs as clients. And then I'll take off the educational hat and I'll give you like my 3-minute spiel on if you want to work with us, how to reach out, that sort of thing, services we offer. And then we'll go to a Q&A at the end. I think we're still on track with time just because we got going a little bit later. All right. All right, so this is I threw some screenshots. So this is the freebie I'm going to send out, and I'm just going to walk through real quick because there's a ton of stuff on the screen here. And I always joke there's like no greater sin in finance than trying to interpret somebody else's spreadsheet that they made because it makes sense in my head. So all you're going to do when you download this, just edit the green cells, okay? And it'll total everything. These are going to be all like your 100% automatic write-offs, and they're all CRNA specific. Then there's 2 other tabs on the bottom for the vehicle write-off component of it. I've set up the formula so it'll automatically help you optimize. Does it make sense to take the mileage or actual expenses? And then same thing with the home office portion of it. So everybody will get a copy of that. And then I run through kind of like a freebie. What I usually offer on these webinars is kind of our way of approaching financial planning and helping you kind of triage a quick financial scorecard. So that's kind of like my offer to everybody for being live on the webinar. So hopefully I don't eat my words and end up having to do hundreds of these, but we'll see. The analogy I always use is kind of like the doctor patient model, right? It's not a sales model. It's I've never met a doctor that's excited to sell a cast, right? Prescribe a course of treatment, whether you choose to follow it or not, it's completely up to you with the right guidance. So beat that analogy to death. I think a good doctor should take tests and help you measure your scores specifically against your peer group. So we work almost exclusively with CRNAs, and I found that CRNAs are a pretty competitive group. So it gamifies some of these scores, and it's less all right, I got to talk to my guy, twice a year, and it's like eating vegetables or going to the dentist. It gamifies it. So what we do is we try to take, the 1,000-page long financial plan, which appeals to me. Like I love that stuff, but I almost look at it through my wife's eyes. She could not care less about any of this, right? Like she would just want to meet with her advisor and like, am I on track? And what do I got to do next to stay on track? So this is kind of our methodology for doing that. And by putting it into vital signs and in a profile like this, we're almost able to practice like preventative financial care. Whereas you meet with your doctor, they're going to talk about your history, which we would obviously do if you're a client. And we would benchmark your vitals and say, all right, Jen, you're going to have before you have a heart attack down the road, let's get your cholesterol under control. So what are those glaring things that we can look at money-wise, right? So we kind of break down a series of these, and I'm not going to read everything off the slide, but basically each of these is trying to answer 4 questions. So that's going to be the freebie at the end of this is I'll send you guys I'll put a QR code on the screen. It's a 4.5, I've timed it's like 4.5 minutes. You can fill out the quick questionnaire, and then I'll send you a quick little 5-minute Zoom video of a couple strengths, a couple weaknesses, areas for improvement, basically trying to answer these 4 questions. If you're too conservative as far as a risk profile, you're at risk of losing purchasing power. If you're too aggressive, you're really one bad year away from hating investing. So trying to find that sweet spot, breaking down, are you using your income wisely? Income can only go 4 places. We're saving it, we're spending it, we're paying down debt, it's going to Uncle Sam. So again, triaging if there's like a leaky bucket of, all right, these don't add up to 100%. Where's the money going? And I think budgeting is a bad word, right? So to like get off the soapbox here, but I don't want to be like my own wife's pocketbook to that extent, let alone our clients. Like what she spends at Starbucks every week is crazy to me, but that is not my focus, right? So the way we work with clients and with my own money is like, I just want to hit this savings rate, right? This would be like first class citizen, somebody who is eating right, exercising every day. That's going to be a future leading indicator of future physical health. Having a great savings rate, future indicator of financial health. So it's like the Warren Buffett quote, right? You want to spend what's left after saving. not the other way around. So that's what we really try to focus on and say, all right, at the beginning of the year, we're putting together a cash flow game plan for this year. How much should we be setting aside for taxes? We want to go ring the register and pull every single lever we can with all these tax advantage strategies. How much should we be peeling off and setting aside every time you get paid, right? And to be able to fund these types of accounts, kind of using back the napkin math, reverse engineering it. And then, having the right mix of assets. I'm not going to go into what all these mean on this call. If you fill out the questionnaire, we'll get more into the weeds on it. And then ultimately, how much money you need to make work optional. So basically, it's how many years could you live off the money that you've set aside in that kind of a retirement readiness score. So the example would be each of these, we kind of have a target that we're trying to get to specifically, again, for your peer group. And then where, if it's low, if it's high, you can back into how everything looks there. Get a health indicator, target score, your score. And then again, Alan and Anesthesia here, their scorecard. It's a way to measure progress over time that's highly personalized, right? And I think for progress to be meaningful, it has to be personalized. Right. So the main takeaway is being able to look at it on an ongoing basis rather than, measuring your progress by, the Standard & Poor's is usually a pretty poor benchmark, or measuring progress by your buddy's Robinhood account screenshots. Probably not a good way to break down, where things are headed in the long run. So that's this app. Again, 4.5, 5 minutes. They will run through a couple questions. Don't spend more time than that on it. I don't need to know like to the penny what you have in your checking account. Just round numbers for accuracy, and then I'd send you back that quick video. So that I've got another slide with Q&A here. So I don't know. I've got a couple more things at the end, but I've just put this on here as a quick reminder. We're going to get to the Q&A here in 3 minutes. Throw your questions in the chat. And anything that we don't get to, I'm sure there's a ton of questions in there. And just for the sake of time, I will follow up personally to everybody's question via email. So feel free to throw your questions in there. We'll get to all of them. And then to Jen's point earlier, we're going to do like an open office, less formal presentation, just an office hours, I guess you could call it, next week as well, for about an hour, where you'll be able to get like some one-on-one questions answered too. So before we jump into Q&A, I'm going to put on my sales pitch hat here and just kind of give you an idea of how we work with clients, what we charge, that sort of thing. So again, this isn't intended to be a sales pitch, but if folks are on this call saying, hey, this is what I'm looking for, what are some of those other questions? I can give you a quick rundown of that. So every client we meet with, we try to put together a 1-page plan with the idea.
Okay.
Was that? I wasn't sure. Somebody's talking to me. Okay. Yeah. So with the idea being, we put this together. I think
You just got muted, Ben.
what are those goals we're working towards? What are the next steps to stay on track? And we send this out ahead of every meeting to make the most of our time together. I found that when it's 80 degrees in the summer, it's the last thing people want to do is talk to me about mutual funds. So try to make the most of our time together. And then if there's stuff we got to research, hey, I'm thinking picking up a contract in Wyoming. What do I got to do for state registration there? Let's get it added to the docket ahead of time. That way, make the most of both of our times. All right. So maybe the biggest differentiator of our firm would be the integration as kind of like the proverbial one-stop shop. So when I review tax returns, I very rarely see errors. I mean, nowadays with software and AI, it's really hard to screw up a tax return. And most accountants and most CPAs are really great at putting numbers into boxes, right? Year's already over. Here's my W-2s. How much am I getting back? It's a very reactive process. So we try to flip that on its head and make it a proactive process, whereby not only in the spring are we filing tax returns for everybody, we're also bookending the year with a fall meeting, September, October timeframe, where we put together what I call a tax projection. You get us your year-to-date 1099 income, year-to-date estimated expenses, W-2s, blend of different incomes, spousal income, rental property, all these moving parts. I want to literally put together a mock tax return to make sure we don't miss any opportunities. I don't see the errors, but I see tons of missed opportunities where, man, shoot, we should have done X, Y, Z. You should have bought that Escalade in December instead of January, and that would have saved you 40 grand in taxes. But now you're not going to get that tax benefit for another 18 months now. Right. So just little things like that is where I think a lot of tax firms kind of fall short. And just like in medicine, right? It's like almost the silo syndrome where the left hand doesn't know what the right hand's doing. We've tried to bring as much of it in-house. So you're not coordinating 5 different professionals to get the results. So just more client experience stuff. In addition to filing the tax return in the spring, we also put together, I call it a cash flow waterfall. Maybe I'm just more visual, but just literally trying to assign a job to every single dollar at the beginning of the year. Here's the money that's coming in. Here's the lifestyle we're shooting for living wise. Again, not budgeting. Budgeting is a bad word in my book. How much do we need to be setting aside for taxes? We want to go pull the lever on every single one of these strategies. What should we be setting aside for savings? Spend the rest of it. Right. You want to pick up an extra call shift so you can go to Cancun and take the family. Great. That's the point, is trying to find that right balance. Maybe that's where the art meets the science with it, because this is a different answer for everybody of trading what you can do with dollars today to invest for tomorrow. I'm the first one to tell you, like, there is that balance for everybody. So I like doing this from the standpoint, it almost allows for like guilt-free spending of, hey, Ben said we're going to be good as long as we set aside this for taxes and this for all these different savings goals. Light the rest of it on fire, right? The guilt-free spending part of it, I think, is huge. That's what has worked for us, personally. I'm not going to read everything off. Again, one-stop shop. Ideas, kind of your money, our services. So everything that goes into really forging a durable retirement, long-term financial plan, everything that goes into the investment management piece, making sure money goes to where it should, both during life and after death, aligning everything with the goals, being able to evaluate, hey, if we go buy this lake house, or, I'm going to take I only work 6 months every year because I've got this great flexibility with 1099 work. How does that really change my long-term, projection on when I'll be able to completely retire? And then the last thing I'll say here, we do insurance analysis. I used to have all of my life insurance, accident, disability, health insurance licenses. I've let those go, not because it wasn't lucrative to sell my wife's high earning income CRNA's life insurance, but to be candid, for lack of a better word, it's kind of a shitty way to have a relationship with somebody that you're supposed to be trusting with your life savings. For example, you need a $2 million life insurance policy. Well, obviously, that's going to pay me more than a $1 million policy. So right off the bat, you're like, do I really need this, or is Ben just trying to get paid more? So because of that, we're never going to recommend anything you don't need, but also it's a part of the overall financial plan. And when it comes to financial planning, it's much more important to prepare than to repair, right? And if we can help insure all the stuff that's going to go wrong and trade certain risks to an insurance company, now we can invest for the things that can go right. And the disability policies, no joke, because I don't sell the insurance, we've got social media presence and everything. I get a half a dozen emails a week of disability insurance guys saying, hey, I see you work with CRNAs. Would you mind? We'd love to take your referrals. So there is a need for it. It's one of the most oversold policies out there. Most people carry way too much disability insurance, and it's because it's one of the most lucrative policies to sell out there. So I'll take my disability soapbox and put it away. But look, anytime you're looking at something along those disability policies specifically, or even permanent life insurance, and I have skepticism would probably go a long way. So with that said, I think 2 more slides here. So just ongoing client experience. So every semi-annual meeting we do in the spring, March, April timeframe, we're pushing send on the tax return. We're putting together that cash flow game plan. In the fall, bookending the year, we do that tax projection. Most folks are in their open enrollment period, insurance-wise, so just making sure everything's buttoned up and dialed in there. And then every quarter, just market commentary. Hey, here's the tweaks we made to the investment strategies over the last quarter. Here's the outlook and how things are positioned for the next. Here's your performance, fees, dividends, all that good stuff. And then every month, we send out a different vital sign, specifically benchmarked against your peer group. So that Element software is that vital scorecard. I got the guys from that run that company to send me all of the back end 7,000 clients that use that software, with 6,000, whatever it is. Build my own Excel spreadsheet, and basically can benchmark not only against our practice, which is specific to CRNAs, but everybody that uses the software. So to be able to say, hey, somebody between the ages of 40 and 50 that makes more than 300 grand a year, how does your savings rate stack up? Which decile do you fall in? And again, it kind of gamifies some of this, right? And usually the question I get from CRNAs is, who's got the highest savings rate? Who's got the lowest debt rate? Of people you work with. So I think it's a way to make it a little bit more enjoyable than looking at spreadsheets. And then I have a weekly newsletter I send out, and then we don't charge by the hour. So outside of this frequency, if there's ever, life happens, right? Get a contract canceled, you get married, divorce, death in the family. Like, we always jump on calls outside of that frequency. But again, hopefully if I'm doing my job right, there isn't a huge reason, because we're covering so much throughout the year, passively too. Yeah.
Sorry to interrupt you, but just in the essence of time, we're running a little bit low here. Is there any way we can get a couple questions out to you for some of the people that are sitting?
Yeah, absolutely. This is the last slide here. So
Okay.
different service models we offer. The one thing I want to point out is this fee only fiduciary status. Fiduciary is a buzzword, means I have to legally put your interests out of my own. What that translates to, it's kind of like the first do no harm. I've never met an advisor that doesn't claim to be a fiduciary. So the key distinction is this fee only status. What that basically means is I'm only paid directly by our clients. I don't get to take my wife on a cruise if I sell a certain number of mutual funds or steak dinners or anything crazy like that. We have essentially a couple different service models for SRNAs. Whoops. For SRNAs here, we basically do SRNA taxes for free while you're in school. So we don't charge tax prep fees or financial planning fees. The idea there is we can I don't know, kind of give back a little bit, help folks build a strong foundation when they're in school. There's a ton of we do a whole webinar on that. There's a ton of planning things that you should be doing if you're an SRNA on this while your income's zero for a couple years while you're in school. And then we also we offer investment management. Most folks offer this on Point Plus. We charge a percentage of the assets under management that starts at 0.1% per month. Goes down significantly, basically for every $1 million that we manage for clients. And then in addition to that, most folks offer this because we charge an additional $100 a month as far as just a financial planning retainer. If you have an S corp, it'd be $200 a month. So contracts super straightforward. Either one of us fire at each other at any time. But that's really the different service models that we have set up here. So I'll let you kick it off to Q&A there, Jeff.
Okay, thanks. Actually, I'm going to let Jen go ahead and start with the first question.
All right, we have a question here that says, I have an S corp and I want to open a solo 401k. How much is the max I can contribute if I pay myself a wage salary of 120,000?
So it's going to be a combination of those different amounts. So for last year, assuming you're under 50, so you could do the 23.5, assuming also you don't have W-2 income through the hospital. So you do 23.5 as the employee portion, and then you could give yourself a profit sharing of 25% based on that W-2 salary. So you could do another 30 grand. So we're at 53.5. And then the total aggregate amount, the section 415 limitation across all plans is 70 grand. And that's where that after tax component comes in. You could do an additional 16.5 then as an after tax contribution. So all in all, it's 70. It's just different, how they break out.
Matrina, you got the next question? You're on mute.
Sorry. Next question is, can you have multiple solo 401k accounts?
Yes. In the way that we typically set it up is you need different sub accounts. So you'd have a pre-tax solo 401k, an after-tax, and a Roth. And those would be 3 different separate account numbers to, basically keep track of without commingling the funds and everything. There would be no point to have separate solo 401ks. And maybe the root of the question is, could I set up 2 of these and do twice as much? And the answer is no.
The next question was, who do you like to use for your high yield savings accounts?
Yeah. So high yield savings stuff, you can rate shop that. The one thing you just want to make sure is FDIC insurance is a big part of that. From safety, typically online banks are going to offer a little bit better rates than maybe your local credit union down the street because they don't have brick and mortar overhead. So right now you're probably looking at anywhere from like 3.25% to 3.5%, if I had to guess. If you wanted to get really creative, you could buy a money market mutual fund, but then you start to introduce some credit stack risk in terms of the underlying positions would be like short-term government securities or bonds. And there's a little bit of illiquidity because you have to actually go place the trade. It's on the mutual funds. They trade in dollar increments. There is risk there. Back in 2008, there were a couple funds that broke the buck, meaning they dipped under $1. It's supposed to be safe money. Before that, maybe you're able to add, I don't know, 0.5% of yield for that little bit added risk.
Okay. Our next question is from Jamie, and she's wondering if you can address any difference with different states. Is that maybe too broad of a question? You have to talk to them first. She's from California.
Yeah. So California is notoriously difficult to get a couple clients out there. California is going to require a PLLC to be set up. Every state has such nuanced rules. And we've got 2 CPAs on staff, but that's really all they do is state compliance for all of our clients in all these different states. I know in like Michigan, you can't put CRNA in the title of your LLC. Other states have no issue with that, right? So there's all these nuanced entity formation rules. Broad question, broad answer, I guess.
No. This question came in back with your first scenario with anesthesia. It's Karina said, if anesthesia withdraws that money from her 401k, aren't there penalties for that? It was the very beginning of the.
Not necessarily. No. No. So yes, if so you always have access in a Roth IRA to what's called your basis. So, after 5 years, you have access to the amount that you've contributed to the plan. Now, let's say you did the $9,000 and it grew to, or $33,000, I think was the first example, and it grew to 50. You wanted that whole 50 grand out before age 59 and a half. You're going to pay a 10% penalty on that 17 grand worth of growth, not on the full 50. You always have access to the basis portion, as long as it's been set up for 5 years.
The next question, Lex asks, what are your thoughts on tax strategies for a full-time 1099 versus someone who is two with part-time 1099? Any major differences on how you approach those accounts?
Yeah. So the first thing you want to evaluate is the payroll taxes, right? So does it make sense to make an S corp election? Most often not. Meaning Social Security wage base, that 15.3%. When you're W-2, the hospital's paying 7.65 of it. And then you're paying 7.65%. Comes right off your paycheck when you're W-2. The IRS looks at everything in totality. So even if you had 5 W-2 jobs and 5 1099 jobs, it's just the first 184.5 that is subject to the Social Security tax. So if you're already over 184.5 through your W-2 job, making an S corp election, even if you made 200 grand in W-2 and 200 grand in 1099, I wouldn't tell you to make the S corp election because you've already covered that, the Social Security part of it. As much as I'd love to charge you more to do an S corp return, juice wouldn't be worth the squeeze because you're not avoiding the payroll taxes. In fact, with the S corp, you're just again reducing that QBI amount versus you'd be able to get the QBI potentially on the full 200 grand in that example.
Okay, next question is from Karina. She asks, what's the lowest reasonable salary you've ever seen for a CRNA?
The lowest, again, it's all relative to income. So I have a CRNA that's going to go basically part-time this year. She was previous years, $300,000-$400,000 of income, kind of general glide path to retirement's the idea. So she's going to be, I want to say she says she's going to fall around like 120 grand this year. I think, why would we pay her $120,000 salary, right? So then the question is, does the S corp make sense? How do we segment it? Does she have any other write-offs? Where does she live? So we ended out at like, I want to say a $70,000 or $75,000 salary.
The next question was, when you say include health insurance and HSA correctly on a W-2, what do you mean? Like, how do you do that on a W-2?
Okay, so functionally, your S corp, again, from the example before, you pay yourself a $120,000 salary. You have self-employment insurance expenses, HSA contributions, and health insurance. This example make math easy to say those both amount to $20,000. You have a choice. You can just take that on your personal tax return as a write-off. You get to write off self-employment health insurance, and you get to write off your HSA. Write that off on your 1040 tax return. The creative part of the planning is to funnel it through your S corp payroll. So now your reasonable salary is still the 120 grand, but health benefits and HSA benefits, when it's included as you being more than a 2% shareholder, aren't subject to those 15.3% in payroll taxes. So we still get you to the 120 a reasonable salary, but now you're only paying payroll taxes on the 100. You're taking the write-off on your business tax return. You're including in an income on your personal W-2, and then you're reporting that on your personal tax return as income, and then taking the deduction on the personal tax return. The net benefit's still the same. You get to save 15.3% on that extra 20 grand just from creatively funneling it through the W-2. I've got a in-depth blog post on the On Point CRNA website as well that like crunches all the numbers and math and everything, because I know I'm like word vomiting a bunch of math. So a lot of these strategies, if you guys go to the Learn tab on the website, tons of blog posts that we put out on that.
Our next question is, any other tax strategies for an S corp if you can't include health insurance write-offs because you don't have it? example, retiring from the military and will have health insurance through my retirement.
Yeah, we work with a lot of ex-military. I don't think it's surprising, right? Military, pretty driven people, and going out on a limb and going the 1099 route. I think we've got a few dozen ex-military, full-time 1099 CRNAs. So, totally get that. Now, what we would look at doing potentially, and this doesn't apply to just military, but other things we didn't talk about. Do you have a spouse, right? So maybe you're the breadwinner, spouse doesn't work, or even if the spouse does work, it's better if they don't payroll wise. But maybe we pay your husband or wife $30,000 a year to do clerical work, help you get credentialed, manage your schedule. We're going to pay them 30 grand a year. With that $30,000 now, because we're paying them a W-2 out of your S corp, you got to pay 15 to 15.3% payroll taxes. But that full $30,000 we can then pump into a solo 401k between the employee and the employer contributions. So you're in the 35, 32% tax bracket. I'd rather you pay 15.3% than 32. And then we can still, and then you're paying more into the Social Security system, which is a whole other conversation. But that would be one idea.
Okay, I'm going to ask two here because one I believe you already answered. Do you have a sample accountable share, a plan to share? So
Yeah.
We'll put that in our follow-up email to everybody. Okay, so Kenneth asks, are you able to invest the distributions from S Corp and how is that taxed?
Yes. So the distributions. So there's, and I'm going to try not to get too long-winded in this answer, but I do hear this question all the time. How do I pay myself out of my business? You can move money the day you get paid out of that business checking account to your personal account. It doesn't trigger an immediate tax. The IRS doesn't know about it. Like there's no problems there, right? Your W-2 and what you take out from the business above and beyond that W-2 are all taxed the same at a federal income tax level. The whole distinction is payroll taxes. How it actually hits your tax return is going to be the same. It's all getting dumped into the same bucket. Now, the nuance with the distribution part of it is that only that distribution is going to qualify for your QBI deduction. So back in 2017, Trump passed the Tax Cuts and Jobs Act, made these sweeping tax cuts to big C corps, big publicly traded corporations. He said, well, what about the little guy? So they came up with this QBI, qualified business income deduction. And up to a certain income level, if you qualify for it, you get an automatic 20% write-off. You're only paying taxes on 80 cents of every dollar. For the K1 that comes out, which is the form that kicks off everything above and beyond your W-2 out of the S corp. Still taxed the same way. And yeah, you can invest it. We just can't use that for the formulaic reasons to max fund retirement accounts. Put it in a brokerage account, still put it in an HSA, still do a regular backdoor Roth, 529 plans, just can't be funneled into a 401k.
Madrina, you got this
It's
one? Or
you.
Okay. This question's from Eric regarding solo 401k Roth and mega backdoor Roth. What is our current federal tax rate? For most of us, it's currently 35%. If we go Roth route, now we pay 35% right away. On the flip side, if I retire at 55 and slowly transition pre-tax to Roth while at, say, a 22% rate, wouldn't that be smarter?
Yeah, he's all over it. Yeah. So what he's talking about is tax bracket arbitrage. You're in a higher rate today when you're working. I agree. We should be maxing out every pre-tax bucket first. Now, who the hell knows what tax code's going to look like in 20 years? Working with the info we have now, you're definitely not going to be in the 32% tax bracket. You're not making any money in retirement. And to his point, he's talking about doing Roth conversions in those lower income years. Now, we would also want to, in an ideal world, pay for those Roth conversions, not on the conversion itself, but with money outside of it to get the maximum amount into those plans. What I was talking about earlier was maxing out all the pre-tax options after you've done almost like this hierarchy of buckets you want to fill up first. Once you fill up all those buckets, the next best thing to do would be this mega backdoor Roth rather than just saving those dollars in a brokerage account.
All right. We got time for only about 2 more questions, Ben. We appreciate you hanging in with us.
Like
Go
we
ahead.
mentioned, we're going to have another opportunity for you to ask Ben your questions next Tuesday, the same time, 7:00 Eastern Standard Time. But we'll get a couple more in right now.
Fire away. Make them good ones.
Staley asks, I missed when you said no need to keep cash in the business account. You move all the money from business account into what type of account each month?
Personal account, right? So I always joke with my wife, like I want to be Chase Bank's best worst customers. I want to make a bunch of money and deposit a bunch of money there every month, and I want to get it working harder for me in other areas. Right. So being too cash heavy, while it is like a security blanket, can be, your purchasing power just from inflation can get eroded over time. So what we try to do is I keep minimal amount in a checking account because that's not optimized. And then what we shoot for is almost like a tier 1, tier 2 cash reserve, whereby to make it really easy math, 2 to 3 months of living expenses in your personal checking account, nothing in your business checking account, 2 to 3 months in a high yield savings account. You're covered for 6 months that way if you get canceled in contract or sick, or, usually it's 6 months for long-term disability would kick in. At that point, we basically built our own insurance policy, have enough, war chest, dry powder set aside to cover you in that interim. Everything else beyond that should be invested and working harder for you. And it isn't necessarily, let's go invest in the stock market or Bitcoin or something crazy. There's a spectrum between conservative and aggressive, but that would be typically what we recommend is get your money working harder for you. Let's fund these different types of vehicles where you also get a tax benefit on top of it, and then get it invested and go inside there.
Okay. Last question. This kind of addresses our company as a lecturer, an anesthesia conference. She wants to know about write-offs. When one attends an anesthesia conference, this is from Catherine, can you only write off 50% of meals purchased there? And maybe you could talk a little bit about writing off conferences in general.
Yeah. So I always joke, like you can write off anything you want, right? The problem is if you get audited, you're gonna have to prove it. So I think there's a way to be aggressive in the right way in that regard. Yeah, typically, for a couple of years ago during COVID, it was 100% write off with business meals. If you're traveling, depending, you might be able to take a per diem amount, which could be more than the unreimbursed expenses. But largely, I think it's pretty easy to demonstrate. If you're going to a CE conference in the Bahamas, that's what you're going there for, right? The flight's you're going to be able to write off. Now, if it's out of the country, there's some nuance there with how the days are prorated and everything. But you fly to a conference and you spend 3 days there, Monday, to say Wednesday, Thursday, Friday, and then you fly back on Monday, you're able to write off all the days of the lodging, right? The majority of the days were still spent for, business purposes, and then 100% of the flight would be. As far as the meals and everything, when you're there, they just changed this, so I'd want to confirm it, but I believe you're still limited at 50%.
We want to thank you very much, Ben, for sharing with us, and thank everyone that attended. And we will get recordings out to you so you can review it. And hopefully anybody who missed it, they'll get the recordings too. Thanks for sharing your time with us and all your expertise here and giving everyone, this is a hot topic. We had a lot of people sign up, so it's definitely an interest. We'll be continuing, Discovery Anesthesia is going to continue this webinar series every month. So please check our website often and come see the next topic for next month.
Also,
Thanks.
we're having a sale for CRNA week. So if you are interested in purchasing any of our lectures, we have 2 25 package lectures, 25 credit packages, and 112, and we're giving a 10% off discount for CRNAs this week. Matrina, what's the code?
CRNA.
Go for it, Jeff.
It's the code CRNA10. You can find us at discoveryanesthesia.com.
Thanks, Ben.
Absolutely.
Thanks, everybody.